It's 10:17 p.m. on a September night in Manhattan. A 27-year-old analyst is sitting completely alone on a deserted trading floor. He opens a file slipped to him by a fired colleague, runs the numbers, and his hands go cold. The data inside that file revealed that his firm was currently holding $1.2 trillion in mortgage-backed assets. This diagram illustrates the mathematical trap they were in. If the market value of that towering $1.2 trillion column dropped by just 25%, the resulting loss would be larger than the entire net worth of the company itself. The math revealed an immediate reality. These assets were already worth almost nothing. The firm was sitting on a financial bomb that had, on paper, already detonated. The most urgent question here is how some of the sharpest mathematical minds on Wall Street accidentally built a doomsday device without a single internal alarm going off. By midnight, the CEO is flown in by helicopter. He's an executive who hasn't been on the ground floor in years, relying almost entirely on macro-level historical modeling to understand what his traders are doing. Here is the chart Wall Street used to feel safe. It's a visualization of a system called value at risk. By analyzing decades of market history, it creates a daily weather forecast for money, showing a massive green zone where losses are capped, and predicting that 99 days out of 100, you are perfectly fine. The fatal flaw in this model is that it only accounts for normal historical conditions. It tells you absolutely nothing about the one day that destroys everything. The day systemic failure pushes the market completely off the map. Relying strictly on these standardized historical models creates a lethal blindfold. It ensures that when a collapse finally comes, nobody will see it until the losses are too massive to survive. The toxic data destroying those models had a very specific origin point. Banks were handing out ninja loans to ordinary people, meaning no income, no job, and no assets. This animation shows how Wall Street handled that risk. They took thousands of these highly unstable individual mortgages, bundled tightly together, and sold them as a single product called a mortgage-backed security. Grind enough questionable ingredients together, slap a AAA rating on the paperwork, and suddenly, this block of terrible debt is officially graded as safe as a U.S. Treasury bond. Because they looked perfectly safe on paper, the firm was able to sell these toxic bundles all over the world. Pension funds bought them, retirement accounts in Germany and Iceland bought them. But now, staring at a $1.2 trillion hole, the CEO makes an unblinking choice. To save his own firm, he orders his floor to immediately liquidate every single worthless asset to the very clients who still trust them. In Wall Street's moral calculus, there is no right or wrong. There is only survival. And today, survival requires the deliberate, knowing betrayal of the market. At 7:30 the next morning, the firm's traders pick up their phones and call their closest industry friends, offering up billions in risk at a steep discount. By 10 a.m., the wider market realizes this is a fire sale. Panic sets in. The value of the assets cascades downward, hour by hour, from 96 cents on the dollar to 85, then 73, then 64 cents. By the closing bell, the traders hit their targets. The firm cleared its books and survived. It was a perfectly executed trade of logical self-interest, and by executing it, the firm pulled the trigger that guaranteed systemic collapse for everyone else. The cinematic story of one firm perfectly mirrors reality. This precise liquidation scenario played out across every major investment bank in September 2008. In the aftermath, $11 trillion in wealth evaporated. Pension funds packed with those supposedly safe securities lost 40% of their value. 6 million families lost their homes. And the government responded by writing a $700 billion check to rescue the very banks that built the bomb. The financial system did not break down. It functioned exactly as designed. It treated ordinary citizens not as participants, but as the necessary collateral damage required to keep the cycle running. If you want to go deeper into the 2008 financial crisis and what it revealed about how the system actually works, I've linked some recommended reading below. Was the 2008 crash inevitable, or did specific people make specific choices that destroyed millions of lives? Tell me in the comments and watch the next video on our channel.